Hi, howdy. I'm Patrick Huey with Victory Independent Planning, and welcome once again to Wednesday, otherwise known as
Hump Day,
yeah,
yeah!
that's right. It's Hump Day. And this is Victory's virtual workshop creating confidence and clarity for your financial life. Okay, so we wrapped up the second quarter, making it to the halfway mark of 2024, and the crowd goes wild. Something like that. So let's recap where we've been, give a few hints here and there about where we may be headed for the rest of the year. Honestly, not that I know any more than anybody else out there, but there are some signs that we can pick up on. So first of all, what's been happening for the year 2024? How's the market doing is a fairly common refrain, and it really does depend on what market you're talking about. Let's take a look at four different allocations or examples of allocations that you could be in, something like these year to date, how they've done. So the first one would be SPY. That's actually an S&P 500 index fund, up 17.6%. Then as you go to your more moderate allocations, AOM is a moderate allocation. It's up 5.3. AOK up 4.1. That's a conservative allocation. And AGG, which is the aggregate bond index, is basically flat for the year. Okay. On to those examples since the bear market started in 2022. And I think this is interesting. I put this up on my website for that reason, because it really does indicate just how uneven this recovery has been. You had stocks and bonds go through a bear market, which is somewhat unprecedented to begin with. And then the recovery from there has been, as we said, uneven. If you look at S&P 500 as referenced in the SPY, which is an index fund, it's up 21.5% since the beginning of 2022. Whereas if you're in a moderate or conservative portfolio, as exampled by AOM and AOK, which are index funds which track those moderate and conservative indexes, you're up 1.2% or down 0.91%. So the more conservative you are, going all the way down to the aggregate bond index, which is down 8.05% since the beginning of 2022. And notice it was down almost 16% back in October of 23. And it's come rallying back, but you're still not quite halfway back yet. If you had told a bond investor that that would ever happen to them, they would probably have been fairly surprised at that point. So the market, and we put that in quotes for a reason, the market year to date. If you take a look at four different exchange traded funds that represent various swaths of the market, you start to see the point here. The first is MAGS, MAGS. That's the Magnificent Seven Index. That's the best performing seven stocks in the S&P 500, all in one index, right? Up 47.47% year to date. That's pretty good. Then you go out a little bit, you include the next 43 largest stocks, and now you get a 26% rate of return. So you're knocking 20 percentage points off by diversifying from 7 to 50 stocks. And then if you go from 50 to 100 to 500 stocks, going from that XLG, which is the 50 biggest, to the 500 in SPY, well, you're only up 17.68%. And then if you further go out to the largest 1,000 stocks, what would kind of be called the market, but in this case, you equally weight them. So you're looking at the average stock. Well, it's only up 1.45% year to date. So how's the market doing? Heavily depends on what you're invested in and what your objectives are, as usual, but right now, even more so. How's the market done since the beginning of the bear market? Well, it depends again on what you're talking about. Mags, best 7 stocks, up 78.5%. XLG, top 50, up 32. SPY, up 21. And the equally weighted top 1,000 stocks, your average stock down 1.73% over that period. So if you're looking out there and you're seeing disparities in your performance versus what, quote unquote, the market is doing, take a look at what you're comparing to and understand if you would want to take on this risk of owning the biggest 7 stocks in your portfolio, and knowing that the downside would be fairly tremendous during a sell-off. All right, next up, we're going to talk about some economics, courtesy of our friends at JP Morgan. And we'll take a look first at economic growth and the composition of GDP. So on the left of this page, you've got real GDP in dollars over the last several years. Now, after the US economy recovered fairly rapidly in 2021 following the pandemic, growth has been normalizing towards that 2% trend level. Not bad, not great, but not bad. Nobody's going to celebrate too hard over 2% growth. But then again, you notice when you don't have it, and we didn't in 2020. The chart on the right provides a basic breakdown of GDP for the most recent quarter, showing that once again, consumption is the largest driver of the US economy. So healthy consumers usually mean a healthy economy. Keep that in mind because it becomes important as we're looking at things like the labor market. Well, how are we doing with our finances as a country? Well, still not so good, eh? The slide shows that the recent history of US federal government deficits and debt, along with projections, based on the CBO baseline, along with JP Morgan's projections, if the Tax Cuts and Jobs Acts get extended. Remember, that's going to add to the deficit more than likely, unless growth exceeds that 2% trend line. Now, the left side of this page shows how much the government plans to spend in fiscal year 2024. Guess what? It's a lot, about $6.8 trillion. And it highlights the net interest paid on debt, which is now 13% of the budget. And we've said before in this forum and in others, interest on our debt is expected to climb as high as Social Security and Medicare, these 2 line items down here, within about a decade. The chart also shows the sources of government revenue and how much the government must borrow to cover its spending. And once again, frankly, we're talking about a lot of money. If we're spending $6.8 trillion and taking just in under 5, well, by my math, that leaves about $1.9 trillion to come from further borrowing. Folks in DC, would you please get it together? Now, note in the lower right that as a percent of GDP, our debt is expected to be higher than any time, including World War II, in about a decade, depending if the tax cuts stay or go at the end of next year. So maybe consumers are doing a little bit better than the government. It's a low bar, but yes, we sort of are. Assets are way more than liabilities. And you can see on the right that debt service as a percent of income remains fairly low, at least historically. Consumer balance sheets have held up remarkably during the pandemic, and thanks to the massive fiscal support, now low levels of unemployment have helped sustain that type of tailwind. But you do see a tendency where the delinquencies on loans are picking up. That's the lower right-hand corner, where delinquencies on auto and credit card loans have picked up their trend and are moving back, but not quite, towards 2008, 2009 levels. Student loans, of course, have gone the other direction, but for political reasons and not for economic ones. Okay, on this side, consumer savings. On the left, we show the personal savings rate, defined as personal savings as a share of disposable income. And if you remember during the first years of the pandemic, the savings rate skyrocketed as we had large fiscal transfers, and that filled up our wallets, and we had nowhere to go and nothing to do. As business returned to normal, sort of normal, pent-up consumer demand and rapidly rising prices forced consumers to draw on this excess savings to fund their spending habits, and that caused the savings rate to fall below average levels, as you can see on the right-hand side here in blue. That right hand top chart shows how excess savings peaked during the pandemic, and they're now on their way back to pre-pandemic levels as the personal savings rate has also fallen. And then on the bottom right, it shows how savings have decreased over the past few years for various income levels. Basically, everyone's put away more, although that more has been less. It's been decreasing, except for the lowest income group, which in any economic downturn tends to get hit the hardest. But clearly the plug is out of the drain and the bathtub does seem to be emptying out. Okay. Next up, unemployment and wages. What we're looking at here is the unemployment rate and wage growth for production and non-supervisory workers since the 1960s. And the two measures have had an inverse relationship. They move opposite each other historically, and that continues today as wage growth has declined down to close to its trend number, and unemployment has picked up to 4.1% for the month of June. Now, look, there's nothing disastrous here. The unemployment rate and wage growth are not flashing red by any sense of the imagination. But this recent pickup in unemployment over the last 6 months or so is indicating that the economy is slowing down somewhat. Okay, inflation time. What you note is that after the spike in 2021, when inflation really peaked, looking at almost double-digit levels there, what you note is that after that spike in 2021, we've trended back relatively quickly towards that 50-year average in CPI. And that 50-year average in CPI is 3.8%. But that 50-year average includes the late 70s and early 80s, where inflation was, technical term, ugly. So while this is nice, it's not spike the football in the end zone and do a dance nice. There's still a lot of work to be done if we're going to get consumer inflation back towards the 2% number. And we noticed that the consumer may be draining the bathtub of excess money, but the government is stepping right back in with a fire hose. So, that may continue to be difficult getting back to 2% inflation. But hey, when we're dealing with Washington, we'll just take wins whenever we can get them. Here's where the inflation seems to be manifesting itself these days, mostly in shelter and services, shelter being the blue, services being the light blue. So most of the blue here is where the inflation is coming from, some from odd things like auto insurance, and we're actually seeing a decline in core goods, at least over the last few quarters. So, as long as energy costs remain in check, you'll probably see inflation continue to hover here around that, 3, maybe slightly under 3% mark. If energy were to get out of hand, well, that's going to create some challenging numbers going into the fall. But right now, we don't necessarily expect that. So inflation is elevated, but it seems to have been contained to around that 3% level for now. Here's where we look at what we think is going to happen in the future, or what consumers in general think is going to happen in the future. And they feel more like there is more inflation on the horizon, up to 2.7% or 2.8%, excuse me, versus professional forecasters at 2.3%. And consumers, you see, don't like to be surprised. And most of the surprises in inflation data going all the way back to 2020, and even more recently, have actually been in the wrong direction, meaning data was higher than expected. And we've seen that ticking up lately as well. So consumers tend to react more negatively to that than professionals. Who's right? I don't know. And I don't particularly care. I just care that this trend is not a good one, because not only don't consumers like surprises, markets don't like surprises either. Let's take a look at the Fed and interest rates. And what I want to point out here is that the data in this box. So this is looking at the Federal Reserve's 2024 forecast as of June for things like GDP, unemployment, and headline PCE inflation. And what's interesting to me is that you look at how the economy is expected to grow at around 2%. It's expected to stay around that 2% trend. Unemployment expected to stay where it is, right? 4% now, up to 4.2, maybe 4.1% in 2026. So basically nothing changing there. And yet, and I've said this before, it confuses me how nothing changes, and yet inflation will somehow go down. I don't know. Stay tuned, Fed watchers, for the next exciting installment of Inflation Nation, where nothing changes and yet everything changes. Despite nothing changing, it's expected that the Fed will lower rates at some point this year, ending the tightening cycle. Well, again, stay tuned on that, which has traditionally been a good thing for stock returns after peak interest years. You can see these cycles down here at the bottom and what the S&P 500 did after those tightening cycles. So that average after the 6 rate hiking cycles was a return of 17.6% for the S&P 500. Some down years in there, well, at least one down year. So, it's not a perfect correlation, but the end of a tightening cycle usually is a good thing for the stock market. The Fed's balance sheet, what can you say? It's massive. And only getting slightly less massive, even though they've been winding down their balance sheet since May of 2022. The forecast isn't for much more of a wind down or a contraction. It's hard for me to say if that's good or bad, but looking back in time, it is certainly unprecedented. We are in territory where the Federal Reserve has never been, as far as the amount of reserves that they are carrying. Beating a dead horse here, but the slide shows just how historic the bond downturn in 2022 was and how far they are from rallying back to pre-bear market levels. Down as much as 17% in 2022, ended down 13. They've gotten 6 back and lost another percentage point or so this year, almost a percentage point. So it's been a rough go for bondholders, and it has made the pivot into cash, especially T-bills, all that more important for conservative investors. The answers are out there. You just have to be willing to go out and find them for your conservative portion of your portfolio. Daily market moves, there's not a whole lot going on so far this year. Daily volatility is low. We've only had 10 daily moves of 1% up or down so far this year. On average, you get 64 for the year. So we're well below trend from that perspective. That's nice, at least for my blood pressure. But whenever we're that far below trend line, you know that a pickup is coming eventually. So don't be surprised to see a little bit more volatility, especially as we roll into the fall. And some other things start to happen. That's normal, c'est la vie, as the French say. And speaking of the French, we are expecting a rotation at some point into foreign assets. The U.S. dominance has continued after 14 years of U.S. dominance. We took a slight break in 21 for the coronavirus. And if we ever do cut rates in this country and the dollar falls off a bit, we could see an end to this overall what really is about a 15, 16-year trend in U.S. Dominance over foreign assets. So something to be aware of as we may be seeing Europe and Asia come roaring back for a while. For now, U.S. markets lead the pack when adjusted for currency exchange, with the major exception in this column being Taiwan, also known as the semiconductor industry. So no shock there that Taiwan is really enjoying the AI boom, as are the Magnificent Seven in the S&P 500. So what happens when stocks hit all-time highs, as they have 30 some times so far this year? Well, people get nervous because what goes up must come down, right? Well, sure, except when it doesn't, which happens a fair amount in investing. Indeed, what history suggests is that investing at all-time highs is not even a bad strategy, because new highs are typically clustered together, meaning you get a lot of them in a short span of time. In other words, market strength begets more market strength, at least sometimes. So on the left, we show the S&P 500 price index and mark each all-time high that set a market floor, or an all-time high from which the market has never fallen more than 5%. So since 1950, there would have been many instances, and you can see these in the green bands on that chart, in which an investor sitting on the sidelines with markets near all-time highs would have never seen a better entry point. And I don't think people necessarily think about that when they're looking at their investments and thinking about all-time highs. If you've got money on the sideline, it may not be the best place for it. On the right, we show that returns from investing on any given day versus an all-time high are comparable, and even in some cases better when investing at market highs. Again, because market highs often beget more market highs, at least until they don't. So with all the other reasons out there to be nervous right now, don't waste energy on this one. And speaking of reasons to be nervous, it is, of course, an election year. And while this chart shows how economic perceptions are swayed by whatever party is in power, you feel good when your team is winning and bad when it isn't, something every New York Jets fan knows. I think it is also fair to say that no one over here on the right is particularly happy these days. It's a very low bar for both Republicans and Democrats. But at the risk of sounding political, that might be more to do with what our choices are at this point. Okay, and that's it. Q2 kept us hanging on, and we'll leave you now with the meme of the week. Remember, being on glide path in retirement starts with what I call a SMART approach. So let's make sure that S, your sources of income; M, your medical and healthcare planning; A, your advanced planning; R, your risk management and investment strategies; and T, your tax efficient strategies are all working together for the rest of 2024. I'll be sending this slide deck out to subscribers on Substack, so be sure to join and follow me there. But if you're watching or listening elsewhere, I've got you. Send me a message, an email, a smoke signal, whatever. And I'll send you my materials on this or any other topic in my Smart Approach to Retirement series. You can always hit me up at patrick@victoryindependentplanning.com. Thanks for checking in. And hey, I will see you next week.